I will be recording this presentation for those of you who are wondering, so it will be available through FX Street. Has very graciously been willing to host our video recordings, and so it will be recorded and available for everyone. Right now you should be looking at my opening slide, if you will, just telling you who I am. Everything coming out okay? Okay, excellent. Well, I suppose there's no reason to delay getting started. We're right on time. Let me introduce myself, if I could. I'm John Jagerson, for those of you who have not met me before. I have been in the Forex for a long time. I actually started trading the Forex with an import-export firm where we were trying to hedge our risk, currency risk, which lately we've seen a lot more of that in the press as the dollar has been falling so much. So it's right in my background as to I've been on that side of the business and have been wrote a book on the subject, have a website, pfxglobal.com, which many of you probably know. We have videos every day, blog items, content, forums. So come check us out. And also, here's my email address. Now, to answer one of your questions, so today, specifically, my subject was building long-term trading systems. Specifically, in the description, I mentioned that I was going to be building a system with you, talking about backtesting. How does backtesting work? How can we make it more effective? And what kinds of insights can we get out of it before we begin jumping into the market with a live system? And so I have one that I'm going to show you how I built, what the rules are, and how it works. We're going to be looking at the backtesting as well as we walk through this together. And it's one that I've talked about before. It's a favorite of mine. It's covered options. So that's this trading system we're going to be talking about building today. And so I want to preface this with a couple of comments. First of all, trading in the Forex, the Forex does not care whether you're a beginner or advanced. So there are times when you'll learn something or see something new that looks a little advanced, or it may look a little basic. But don't get turned off depending on if you think it's too basic for you or if you think it's too advanced for you, because really what makes a system good is whether it's effective or not. So I would encourage you to, as you go through this, if it seems a little advanced for you, don't get discouraged, because there are some great ways to get caught up and to be able to use the information in your own trading very easily. It's certainly not beyond any of us here. The system that I'm going to be talking about, when I was talking, some people were sending me some questions before the session about what I was going to be covering, etc. And one of the questions they were asking, well, a lot of the questions that some folks were asking were relative to what technicals was I going to use, etc. And so I have to say that in the Forex, I've noticed that it's interesting actually. It really varies from market to market. But in the Forex, technical analysis, so technical indicators and technical traders really dominate over, let's say, fundamental traders or traders with a slightly different outlook on the market. And so there's nothing obviously wrong with technical analysis. I use technical analysis quite a bit, but this is not the kind of system that you build where you apply a technical indicator, you identify when your entry signal is, and you identify when your exit signal is. We're going to be taking advantage of different kinds of forces and indicators in the Forex in this case, because what we're going to do is we're going to trade off some complexity as far as implementation of the system, and we're going to take a little complexity in how we construct the trade, but we're going to do a little trade-off here so that it's easier to manage, but it has a little bit of a learning curve to get involved in it. But it's not oriented around technical indicators, although I will show you one that I do use to trigger what direction is my trade. but it doesn't really identify it. It really has nothing to do with trade timing itself. So we're not going to be timing the market in this particular system, and that may sound a little weird, but one thing that I would say, without certainly not implying that technical timing is a bad thing, because it's a great thing, but it can be very difficult for a lot of traders, particularly if you have another life. So if you're doing things besides just trading in the market, having a system where you don't have to be, it's not as time sensitive as trading some sort of a technical system, can be an advantage and can be a good addition to your portfolio of strategies. Now, the system that I'm going to be talking about, it's not junior level, but it's very worth the time and effort that it takes to learn it, and it solves a lot of trading problems. So I am, for those who are familiar with who I am, the kinds of things that we talk about on PFX, we will oftentimes take a different sort of outlook to risk control, or the perfect example actually would be stop losses. It's always a good idea to think about how you can manage your risk besides just using that one tool of a stop loss. Now, I'm not suggesting that anybody trade without stop losses at all, but it's always good to be able to understand what the alternatives really are out there in the market to hedge risk and to prevent the market from running away on you. The second thing that I would suggest is that although we'll be going through my particular outlook on this system, it's very flexible, and in particular what I mean by that as far as flexibility is the leverage in the system is very flexible and can really be modified to suit your own trading style. I recognize that I'm a little more conservative than many traders out there, and so there are a lot of things that you can do to control that leverage dial to really suit how aggressive or how conservative you are. And what's great about that is that you can use your backtesting exercise to try to understand what effect does that have on my portfolio, because certainly there's a point where you're going to get the maximum beneficial return possible with a certain amount of leverage, and if you go beyond that, you begin to blow up your account on drawdowns. So I'll make some comments about that as we start to go through it. So let me start to introduce to you what we're going to be talking about. I'm going to go to slide number 2. I want to give a little bit of background, and this is something that is probably not new to all of you, but maybe new to some of you. We're going to be layering an option position against our spot position. So our spot Forex position, whether we're long or short, we're going to be putting an option position against that. And it's a hedge, which means that if we're bullish on a particular pair, we're going to be applying a bearish hedge to it. And so that's just an easy way to kind of think about it. If you're hedging something, that means you're really taking the opposite position. You're changing your you're bringing in a little bit of the other side into your trade, so that you can create that hedge in the first place. So the second thing that I want to make sure that we understand is that there are two types of options. They're available on just about every currency pair. You can do it in two ways. Either you can trade options that are exchange listed. There are some great options listed in the U.S. open to global investors. There are also a couple of dealers who offer options, and in my experience, their pricing is very competitive. So you're really not at any disadvantage for working with either a dealer directly who offers options on their spot contracts, or by having basically two accounts, your spot account and then opening an options account where you can trade exchange listed options. It's really basically the same. So the two types of options that I'm going to be talking about today are calls and puts. So, and we're going to be the option seller. And this is interesting because options are, they're obviously different than the spot contract itself. And when you sell an option, what you're basically doing is you're creating a liability. So, for example, when you sell a call, what you're basically agreeing to do is that you're agreeing that you will sell that you're agreeing that you are willing to sell this particular currency pair, whatever currency pair you sold the option on, for a specific price for a specific amount of time. So until expiration, and then your strike price. And we're going to be talking about that here in just a minute. So what's great about that is that option sellers get paid a premium to be willing to make that commitment. And that premium can be quite juicy, actually. So, and I'm going to go through some very specific examples here in just a minute. Now, the great thing about this is that you may be thinking, well, shoot, if I'm a call seller, that means I got to be willing to sell a currency pair for a specific price. How can I make sure that I don't have, that doesn't run away on me? Well, we're going to be basically buying the underlying spot contract when we sell a call. Which means that we already own that currency contract that we could sell. So when if that option needed to be exercised or what have you, it would just wash out. And everything, by the way, is a lot simpler than that. Being a put seller is just the opposite. We would sell a put when we're bearish on a particular pair, and what's great about it is that, again, it pays us a premium up front. I have a quick anecdote that for anybody who's interested, you're welcome to send me an email if you'd like to see this report. But the Chicago Mercantile Exchange, where currency trading was where it was before the spot became very popular. They did a study on option sellers versus people who are going long the underlying contract, and they actually found that the sellers were doing better than those who were going long. And the reason for that is that when you're an option seller, you're really taking advantage of one of the underlying reasons that the market exists. One of the reasons that the market exists is not necessarily for the benefit of speculators. It exists so that market participants can offset risk. And they're willing to, so this goes back to my history as a import-export firm owner. What I was trying to do was offset risk, and I basically paid a premium to be able to do that. Well, that's where option sellers come in. We're the ones who basically accept that risk. So let me talk about a couple of pros and cons. Here's what we're going to try to do. The number one, and whenever I'm building any system, these are the things that I try to make sure it has to meet all four of these pros. And then we can start to weigh those against the cons that it develops and see, well, okay, so how does that really work out? So let me explain. The first thing that I always want to make sure is that if I'm trading something, I want to make sure that I have control over volatility. Well, the system that I'm going to be showing you is very attractive because if you compare it to just an uncovered system using the same kinds of buy and entry signals, the volatility is cut in half, so 10% versus 23%. And the risk-adjusted return, for those of you who are into portfolio management theory, that's basically a normalized Sharpe ratio, is considerably larger as well, from 0.16 to 0.22. That's where very good hedge funds, very, very good hedge fund managers are in this level. So 0.22. So it gives you a little bit of sense as to, well, okay, so what is one of the primary objectives? We want to smooth our volatility. Two, I want it to be easy to implement and manage. One of the biggest tip-offs that a trading system is not going to be successful is when you're looking at it, if you begin to have doubts as to whether or not you could actually do that. So the perfect example, I think, is, does the trading signal occur at times or periods when you would even be able to execute the trade? Number two is, how likely is it you would be able to get those prices? How significant is the spread? Those kinds of things. Number three is I want to know whether my system has risk management in that it will reduce the likelihood for whips or whipsaws. Am I going to be able to stay in the position for a long enough period of time to realize my profit potential? And this is one I harp on quite a bit, actually, because I talk to a lot of experienced and beginner traders. And I would say by far the biggest complaint that I get about trading in the Forex is being stopped out. Now, and again, I'm not suggesting to trade without stops, but I can say that building any system, one of the priorities in my mind has to be am I reducing the likelihood that I'm going to be whipped out over and over again? Nothing more frustrating than being whipped out of a trade you were ultimately right about. And then finally, of course, does it offer good returns? Are the returns worth the amount of effort and risk that I'm taking? So the cons in this case, and I can say that this system that we're going to be walking through today, it has all these pros. The cons in this case, however, are that the gains are capped. What's interesting about this is that this does not turn out to be a disadvantage, because the hedge reduces our losses. And when you contrast the gains that we may be giving up with the hedge that we applied, it works out quite well. But it does cap those gains. So there were, for example, in my back testing, there were a couple of trades that were 400, 500 pips potential, but I only got a very small portion of that as a percentage, because I had applied this hedge and it had capped my gain. And then it's a little bit complex, so it takes a couple of times through it, and before you really get it. So let's look at a real life example. I'm going to close my slide. All right, so I'm going to go through a past example, and then I'm going to go through an example of this particular trade that I'm in right now, and what am I doing about it right now. And then we're going to jump into the backtesting and talk about, okay, but how well are we really achieving our objectives? And how do we measure those objectives? Well, as we're building a system, we've developed a basic idea, but how do we tell whether or not this really played out in the past, so that it's worth us taking a risk to see how it plays out in the future by actually implementing it in the market? So I'm going to be using some past data here, and we're just going to be drawing some lines to talk about, all right, what was the market doing at the time, and how did that play out for us? We're going to go to my October trade, and the one thing that I want to explain is that as we go through some of these rules is how did we determine our trade? Well, we did it in a couple of ways. So the first is we picked a pair to trade, and I was somewhat arbitrary in which pair that I picked. It really actually doesn't matter. I've done testing on a number of pairs, and they all worked out to be basically the same. And there's a reason for that, by the way, why they're so similar in this particular system, but I won't go into that here right now. So the dollar CAD, we picked our system, and now what we want to do is we want to determine, well, are we going to be long or are we going to be short? This is a trending system, and when are we going to enter our trade? Well, I can tell you, the rule number one is I'm going to be entering the trade on the third Friday of every month. And I'll explain why that is. It's because that's when options expiration is. So we're going to be selling an option and buying or we're going to be selling an option and trading the spot contract on basically the same day. So the third Friday of the month, every month. And in this case, I did that on October 19th. So we're going to go find October 19th, which is right there. Now, on October 19th, what we were trying to do was to say, okay, are we going to be trading this particular pair long or short? So here's rule number two. It's the third Friday of the month, so rule number one has been met. Rule number two is long or short, and the analysis here was very simple. All I do is I look at the commitment of traders report, and by the way, if you don't know what that is or where to get it, you can actually get it on our site at www.pfxglobal.com. And all it does is it measures, well, are institutional traders overall, are they net short on a particular pair, or are they net long? So are there more long traders than short traders, or are there more short traders than long traders? And I just copy their position. So very easy. And the reason why I'm doing that is not because institutional investors are so smart or anything, but because it's I'm just taking advantage of market momentum in general. So there on the third Friday of the month, on the 19th, I'm basically entering my position short this particular currency pair, and at the same time, I'm going to be selling an option that's right around that price, so pretty close. Now you can certainly, and I'm going to talk about this here in just a minute, you can modify what option are you going to sell and why and how much time. It's all of it is flexible, but because we're going into digging into some of the back testing, we're going to have to standardize a little bit. And once we know that the system works based on a very standardized entry and exit methodology, then we can start to get into and say, well, okay, so am I smarter than the system? On a day-to-day basis, could I manage this more effectively than just leaving it open? And so one of my arguments is that you definitely can. I don't think we should ever eliminate our own discretion. Okay, so right here, if you can imagine the end of that day, the end of that candle, when I went short, I've drawn a little line there to represent what that was. And at the time, sold an option against this. So what that did, sure, you bet. I just got a question as to where can I find the COT report. Ray, actually, if you don't mind, let me hang back on that for just a minute, and then I'll actually show it to you rather than tell you. I'll show you where it is here in just a second. Let me finish this example. So at the time, we're basically sitting on top of our entry, and the market shimmies around a little bit and then breaks down. So everything's looking good because we're short. Well, the other thing that we did on that same day, so we're getting into rule number 3, is we sold an option. Now, if we're short, we're going to sell a put because that's bullish. So it's kind of the contrary position. It's the hedge. And if we were long, we would sell a call, which is bearish, which is the contrary position there, or the hedge there. But let's ignore that for now. So I would sell a put, and at the time, what that put did was it paid me. Now in this case, if you look at standardized pricing, it would have paid me about 150 pips. So what I basically did was I applied a hedge to my position that was worth 150 pips. That means that if the market were to run up on me, I'm covered between here, where I entered the position, and here, where my hedge kind of runs out of steam. So that's about 150 pips above my position. I'm totally covered. I don't accumulate any losses in there. Now that may seem a little thin. That seems kind of strange. But I'll show you how this works, because what we're really doing is we're taking advantage of the fact that, the Forex, it seems like it trends a lot, but which is true. But when you look at it on a month basis, it actually doesn't move a whole lot, because traders are pushing it around quite a bit during the month. But if you were to look at kind of the mean price or the average price, it doesn't move quite as much, and which is, you can see that illustrated by the way that a price reacts to its moving average, where it will get really far away from the moving average and then come back to it. So I've got a hedge built in now, and at the same time, however, but I'm short. So if the market does start to decline, I'm going to make some money. Now, the only problem is that I've committed to basically sell this particular pair, or rather to buy this pair at a certain price. So I've capped my gains. And in fact, if the market goes the direction that I forecasted, which is to the downside, I'm not going to make much more than that 150 pips, if you will, that I received as the option premium. So in a way, what I really did was I was short this position, and then I basically went out to the market and said, hey, I'll rent you this short position. I will rent it to you, to the market. And the market says, if you can excuse my silliness, and the market says, yeah, I'll rent it from you for 150 pips. I'll rent it from you, which means that you don't have that's going to protect me against some of my downside. But the market also says, hey, but if I rent it from you, I get all the upside. So am I willing to do that? Yeah, because what I'm basically doing is I'm kind of pushing off the excess risk to speculators so that they can take the risk for me on my behalf, and I'll show you how this plays out. Now, these trades are all a month long. So if I'm in here on the third Friday of October, I'm out on the third Friday of November, which is already passed, by the way. And in this case, the market actually popped up a little bit above our break even, and we walked away with a very small loss. Not a big deal, but a little bit of a loss. Now, we've done this again this month, and I'll show you. By the way, for those of you who are if this system seems interesting to you, besides just the general concepts around it, and you want more specificity, I track this system on my site, and I'll show you that as well, where to get that information, so you can see, well, how does this work in real time, and what was the prices like, and how would you do this from month to month, so you can see exactly what I'm doing if you're interested, and it's free. You can just go check it out. So this month we've done the same thing. Now the COT report says I'm still short this month, so I got institutional traders who are still short. But so I'm eating it a little bit, except that I basically applied, so I'm going to get rid of these 2 lines. I've applied a hedge and protected myself against quite a few of my losses already. So in this case, I actually sold the position again, so I sold the currency pair here, if you will, again. And I've been eating losses, except that I sold my option and made about 150 pips. So I'm now just barely over a losing position, and I'm now stepping in to manage some of my risk by hand, and but even if I weren't, are my assumptions valid? Would they actually, even if I did not have the ability to manage this on a month-to-month on a day-to-day basis, what does this look like if I left it somewhat robotic? So just to review before I jump into the spreadsheet to show you how the backtesting works out and how I look at backtesting, because I think you might find it helpful, some of the ways that I look at backtesting as far as testing its validity. So the rules, number 1 is we're picking a pair to trade, which is somewhat arbitrary, and we'll be entering our trades on the 3rd Friday of the month and the last a month. So we're kind of rolling this trade month after month after month. We're going to be long or short depending on whether the COT report is long or short. It's by the way, for those of you who don't know what the COT report, it only comes out once a week. It's really comes out on Fridays, and except on a holiday where sometimes it'll come out on Monday, the following Monday, and it's really easy to read. It's a yes or no. It's binary, so it either is long or it is short. And then rule number 3 is we're selling that option. So we're going to be selling an option against our short or long position, where we're pretty much at the money, meaning that the strike price on the option is as close as I can get to being at the money, and maybe just 1 move out of the money. So if I'm right in the middle of 2 strike prices, if my spot price is in the middle of 2 strike prices, I'll go to the strike prices just barely out of the money. So it gives me a little bit of room to profit extra. So I'm gonna close the chart here for a second, and I'm gonna go to my spreadsheet, and we'll talk about how would I actually manage backtesting on this. Okay, so and by the way, I don't like to show people stuff that they can't check out on their own. So all this is available to you if you would like any copies of any of this stuff, like the spreadsheet, etc. I'll show you how to get it, because it's always nice if we can share our work, particularly backtesting. There's great software programs that will do automated backtesting, but not everybody wants to spend the money for them, and they can be very complicated. So sometimes I find it just easier to throw things in a spreadsheet. This is one that Wade Hansen, my partner on the site, produced, where all it does is it identifies for me is the COT report. So you'll notice that each of these rows here are 1 week. So and for every week, is the COT report negative? So -1 is what I use to symbolize that, meaning that they're net short, or is it positive? Are they net long? Which way down here at the bottom, they're net long. And then I have, so my trades were basically every month. So this is the 29th trade, 28th trade. And I went back, I figured going back about 4 years, 4.5 years is probably far enough. The market changes fundamentally over time anyway. So going back too far loses some of its meaning. But 4 years is pretty reasonable. And I did 2 things. So these 2 columns right here, are these two columns are what if I were just simply going long or short and just copying the institutional traders. That's all I was doing. If I just copied what they did, what would that do? Because that's a really basic trending system. Well, that's not too bad. It returned this many pips, so 2,559 pips. That was the total. There were some pretty big whipsaws there, which I'm going to show you here in just a minute in a graph. And so month over month, it was a little bit choppy, but which, if we assumed that I was using 3-to-1 leverage, which is very low leverage, I'm sure a lot of you are cringing when you hear things like that. I mean, who would trade in the Forex using that low leverage? But I'm a big fan of controlling my risk. So if we use 3-to-1 leverage on a $100,000 account, it would return $61,000, which is 15% per year. So not bad. That's not bad at all for a very conservative level of risk. And if I scroll over here to the right, I'm gonna show you a chart we're gonna refer to a couple of times. So I have a chart here, and this red line, this is what those returns looked like since 2003. Since January 2003, what did those returns look like? Very choppy, right? In fact, if you look at just the red line, you'll notice that I had this great run up right there in 2003, 2004. And if you go look at the dollar CAD back then, by the way, it was trending like crazy. It was awesome. Then we got a lot of whippiness in 2005, a lot of indecision, etc. And then we finally got a new trend. And you'll notice that I'm just barely above my profits of 2003. That does not look like a reasonable system to me. I don't like the looks of that because it's just these peaks and valleys are drawdowns of 55 to 60%, which is, I think, for most of us would be unacceptable. So is there a way for me to control that risk? Well, there is. And so one of the ways that I did it is these two columns here, AD and AE, are, they both assume that essentially I was capping my gains, but I was limiting my losses. And the way that I did that was I assumed that, well, if the trade goes my way, goes the way that I'm forecasting, I'm going to make 150 pips. That's what this number is up here. And if the trade doesn't go my way, I'm going to offset my losses by 120 pips. That's a very conservative estimate. And I had to go back and determine, well, okay, so what was volatility? What's kind of the average? What's something that I could rely on for backtesting? But you'll notice that my total return is actually very similar to the uncovered system. I made 2344 pips versus 2559. 3-to-1 leverage returned about 14%, so not too bad. But where this really plays out, and why I think backtesting and keeping these kinds of things in mind, these principles in mind, as you develop your system, is absolutely critical. Because if you were to just go on gross returns, you would automatically go to the earlier system. When the second one, the hedged one, you'll notice that it does a lot better in trends. And look at the delta between the two. So over time, over a large sample that becomes more statistically significant, you'll notice that applying a hedge to your system, in this case, actually paid off quite well, in that it lowered volatility and ultimately really didn't damage me too much as far as returns go. Because in fact, at sometimes I've exceeded those returns. And the longer you go on, by the way, so this system is borrowed. This is a very popular trading strategy in index options. Very popular strategy, and it's a great one to add to a portfolio because it offsets risk in a portfolio. But it's a good one to to implement just as a strategy on its own. So, and if you are able to test it, the reason why I can't test it back any further is that the Forex options, you have very, very limited information previous to 2003. But we could make certain assumptions and take it back further than that, but it loses some of its meaning. But if you do have, so for example, in the index options market, you have decades of information, and the further you go in time, the more these deviate from each other, so that you not only get the smooth, but you get an excess return, you get more alpha, if you will. by applying the hedge, because what you're really doing is you're basically going to the market and saying, I'm willing to take some risk and be compensated for it, and I'm going to offset a lot of my very unpredictable risk by doing that. So these are the takeaways from building a system like this. And one of the things that you have to keep in mind is that where I have found these benefits to be the most pronounced is when you're looking at a long-term trading system, something that lasts for a long time, is very regular, where you're not subject to some of the disadvantages of short-term trading, which would include just kind of erratic market volatility during the day, so intraday movements, even day-to-day movements, execution risk. So that would include things like, just the costs of entering into the transaction. We all pay a spread. And in the Forex, although we don't pay commissions, it's a very expensive market to trade, because even if your spread's only 1 pip, that's still expensive. And so it offsets that execution risk. And because you're only entering or exiting the position once a month, you have fewer times when something can go wrong. You have fewer times when you're not at your computer. You have fewer times when it's possible for you to have missed a signal or to have lost out on an opportunity. So let me close, and I'll get to some questions here in a minute. So let me close with a couple of tips, okay? Because I know that this is not a junior level system, but I hope to have intrigued you enough to want to know a little bit more. So let me help you find out a little bit more. I'm going to shut off my camera for just a second. I'm going to bring up my web browser and point you to a couple of areas. Okay, so you should be able to see my web browser right now, and I'm on my site, pfxglobal.com, and I'm going to answer the first question that I got, which was, well, where can I find those COT reports, the Commitment of Traders report, what institutional traders are doing? They're right here. If across the main menu, click on Analysis and then Fundamental Analysis, and it'll pop you right into this main page here. And you'll see the COT sentiment charts, and right underneath you got a list of all of them. We've got the crosses in here, which are actually, we kind of calculate these by hand, and then the majors. So you can see the dollar CAD right there. I'm going to bring that up. The dollar CAD report is comprised of basically two pieces. There's this yellow line, which is sentiment. It's basically a MACD of the difference between the shorts and the longs, but you can ignore that for now, because what we're really concerned about is this black line here. This is our on-off. This is whether they're net short. So if they're underneath this baseline, they're net short, and they're still net short, although they're quite bullish. Their sentiment is turning more bullish. And up here, they're net long. So that was all the way back in May was when we flipped. You'll see the dates down along the bottom. Now, if you'd like to see this kind of a system implemented in real time, as well as getting access to the spreadsheets that I used, and do your own back testing, try your own. One experiment I would encourage you to make is change the back testing spreadsheet to assume that you were not long or short the underlying at all, but that you were merely selling the option itself. What would that look like? It's very interesting, actually. And as Forex traders, we're used to having uncovered risk, so it's not really that big of a deal. In the forums, on the main menu here, there is right at the very top. Let me wait for the page to refresh. Right at the very top, there are some learning groups, and the learning group is called PFX Covered Option Strategy. So right there, you can dig into that. There's all kinds of videos, and we track it every day, and anytime we make a trade, I put it in there. And you can follow that all for free. There's no obligation, obviously. I'm going to turn it over to questions. While I summarize what I've been talking about, I think that the real takeaway here is that I would like to see more traders think about building systems, testing systems, and implementing systems that don't rely on necessarily two things that I think are overused in the market. Number one, just relying solely on technical indicators to identify an entry or an exit order. It's very hard. The drawdowns can be very severe, and it's challenging for new traders, obviously. And two, relying on a stop loss is the only form of risk control, because there are other techniques out there. This is not the end-all be-all solution, but it is one alternative, and it can get the creative juices flowing to be thinking about, well, shoot, there are ways that I can offset my risk without leaving myself completely exposed to systematic risk. So it's one alternative, and it plays out very well when you're trading it in the long term. Any questions? Quiet crowd. Of course, I know we're probably all a little preoccupied with the market. Can you believe equities? It's amazing. Just amazing. Who knows what's going on with the stock market? I mean, 200 points up the last time I looked, which was just at the start of this presentation. That's really messing with things like the yen and stuff. So I'm sure. In fact, actually, I'm kind of glad I got to do this presentation today, because those little intraday movements that are so dramatic, they matter less and less the longer your time frame is. So, which is nice. And if you're applying something that you can help control your risk during the interim time, you're not really at a big disadvantage. Okay, well, I'm going to end my session here. We're right at the time limit, and I appreciate everybody's time and attention. This is recorded, by the way. If you would like to review it, you're going to be welcome to see it. And review it as many times as you want. I have some tips, by the way. If you want to go check out the Covered Options Strategy Forum here that I maintain, I'm the moderator there. I have all kinds of little tips there if you need a little bit of background on how to trade options, and but you're not really sure, but they seem interesting to you. I've got all kinds of background there. If you're already an options trader and this just looks like a good idea, chime in there. You can see what I'm doing, and you can make your own decisions. Oh yeah, so Boyke, so it's a good point. I could have profited at a turn, definitely. To a certain extent, when you apply a system like this, you're really just assuming that the market is going to average itself out. That that the intermittent gains and losses on a monthly basis are, you're going to be engaged in trying to minimize those and act as appropriately as possible, but you're not really overly concerned about. But your point is good in that it was just as likely to have profited at it as lost at it. But in the interim, I've applied a little control on minimizing those losses that were just as likely as the gains, if you could kind of look at it as even odds. Hey, thanks, Mike. I appreciate that. And you're all welcome. Oh, and by the way, last comment that I'll make is you are welcome to send me emails. I'm pretty good about responding to them, so if you'd like the PowerPoint presentation, you're welcome to that. I probably would recommend just reviewing the recording, which will be up right away, so I don't think there'll be much of a delay on that. I generally render them right after we present, and then we get them up there on the site so you can re-review. So thanks, everybody. Have a great day trading. I think this promises to be a very exciting day in the market.